If you look at the business that we have in Canada and you decompose the P from the C, first of all, if you look at the commercial banking market share in Canada, we have a #2 share in Canada. So relative to the size of our overall bank, we outperform in the commercial. On the personal side of the business, if you go back 5 years ago, 10 years ago, 15 years ago, lots of conversations like these it would always come up that, well, you've got the smallest physical branch network and therefore. And so the mortgage share that we would have in Canada, for example, would be around 10%. And that would be less than our natural market share. Part of that historically has been as a result of that branch count that I talked about. And another part of it is deliberate choice, where we have avoided the third-party mortgage channel in ways that perhaps others haven't. So when I put those two together, I'm perfectly at ease with where our market share is. And now we pivot into a future world where sales are increasingly digital. 25% of all of our sales in our retail business is digital, and that's market leading. Those choices, if I were to forecast 5 years from now and 10 years from now, will end up being equalizers as far as the market is concerned. So we're on a journey.
You are making big investments in the technology that will drive
Yeah.
to digital, and only increasing those investments, right? From $2 billion a year now,
Yeah.
you expect to continue that.
Yeah.
The risk of that not paying off, how do you weigh that?
That's a very good question. So when we looked at it a couple of years ago and we said, what's the right level of spend? There is a point in the stacking of your technology priorities where you start to question the returns. We're at a point where we've said we spend over $2 billion in technology right now. What's interesting is the shape of the spend. If I went back a couple of years for you, you would see that 2/3 of the spend is what we call run the bank, so infrastructure, maintenance, et cetera, and only 1/3 was on grow the bank or protect the bank. As I look forward to 2 years from now, you're going to see that go 60-40 in terms of at least 40% in the grow the bank and protect the bank, and we stack them by priority and we effectively auction off the best ideas. And at the end of the day, what we find, while I've said that we're growing our $2 billion spend at a double-digit rate, what we're finding is we don't get to the end of those conversations and find that there are too many ideas that are left on the table. We're funding almost everything we want to do. We don't feel like we've got a budget constraint, and we're making a lot of progress. And the way we do that, by the way, people say to me, how do you increase your tech spend at 10% plus and deliver positive operating leverage to your shareholders? It's because we hold all other expenses in the bank around 2%. So it's a formula for us, it works.
And you've said today that you intend to keep maintaining that discipline and even get more efficient on the cost side. How do you do it? I mean, how much after acquisition, maybe it's easy, but when you're running the business, where do the cost savings come from?
Where you get to has a lot to do with where you started. So we have the highest efficiency ratio among our Canadian peers. And so we're running at 62% efficiency right now. We've taken 350 basis points out of that ratio in the last couple of years, and what we've said is going forward over the next 3 years, we'd like to get it down to 58%. And you get there, remember the efficiency ratio, people talk about productivity all the time. It has a denominator and a numerator. So you get there both by looking at your relative revenue growth and your cost opportunity. The cost opportunity, for sure, has real opportunity as far as the gains we get from that technology investment that I've spoken to before, but we also have opportunities to change the way we work, and we're getting at that in a real way, and we have real opportunities on the procurement side. And when I put all that together with the revenue opportunities that we think we have, we're pretty confident that we'll get there.
You're looking for 1 million new customers in commercial lending. That sounds like a big number. How do you do it?
It would be a big number if it were all in commercial lending. So we're looking for 1 million new customers in personal lending, and it's still a big number. Yeah. But when we look at the immigration into Canada, we look at the net new population growth, we see it in the major markets where we have good participation. We think we can capture a high share of that. And frankly, it is a matter of taking share from others in the normal course that we haven't been doing a good enough job of in the last 5 years. And when we put those two together, we think we'll get there. It's an ambitious goal. We've stated it as a stretch goal, but we think we'll be able to do it.
This is an industry that really feels ripe for disruption. Being disrupted, here and there, of course, by various fintech players. But you could almost see, barring regulatory restraints, it could be disrupted overnight by the blockchain, by any number of new things.
Yeah.
Can you run the business, grow the business, make acquisitions, and worry about that at the same time?
Yeah, you have to. I mean, 5 years ago, if you and I were having this conversation, I would have asked you or you would have asked me as the end nigh, because the threat was that the banks were going to tip over and the fintechs were going to be able to do everything faster and better and cheaper. What we've seen since then is that some of those technologies have been fantastic. Some of them have made the banks better at operating themselves, have made the banks more efficient. The capacity of the banks to create new technologies and to connect to the marketplace is well beyond what we've seen in the fintechs. And so the partnerships, for example, that have come out of that with many of the fintechs has just been good. Good for them, good for the banking system as well. Because when they talk to us about great technologies that they have for the consumer, but they look to us and say, but gee, you have 12 or 15 million customers and you have 200 years of history and you have a brand that people trust and you got a cost of capital that's a little bit lower than ours. So we're finding that the better together model is really working. And when you ask whether we can defend against disruption, whether we can think about the growth agenda, whether we can think about the M&A agenda, the answer is yes, that's what we do. That's effectively the capital allocation challenge every day.
One of the big problems for incumbents is, of course, that you've got a bunch of legacy systems. In the case of the banks, I mean, some parts of the bank run on software you can't even find people to fix anymore, right? COBOL. How do you can't, I guess, rip all that out. So are you patching brand new, the latest and greatest on top of this creaky old stuff?
Where you have to, you do, but I think that the central architecture of the technology stack is more fundamental than that. When we bought the M&I Bank in 2010, 2011, we took a step function increase in our tech spend, and what often you see happen is there'll be a step function change, and then it'll be whittled down over time. And we made the decision then to keep it there at that level. And the reason for that is we completely re-architected our central core of our technology in the bank. So you talk about some creaky old architecture. You will always find some if you look hard enough, but what you would find here is that we believe we have market-leading architecture at the center, so we can layer on applications as opposed to continually spend our time patching.
Yeah, obviously diversified business, but the health of this economy is going to be key to your and the U.S. economy. Here at home, we've seen concerns about housing being really paramount for some banks. Your mortgage book maybe makes you less worried about that, but are you worried, or have we kind of dodged that bullet?
Yeah, I think we have. Our mortgage book is underweight relative to our peers. So from an exposure perspective, it's less of an exposure here than it is to some others. But having said that, when you look at the compounding effect of the measures that we've seen from B20, some rising rates, foreign buyer taxes, and the adjustment of the housing market, it feels frankly like it's pretty much in balance right now. When you look at the most recent total consumer household debt, increasing year over year at 3.7%. That's the lowest increase we've had in 35 years in this country. And total household income has gone up 3.9%. So there's an inflection point there where the lines have crossed, and it does feel pretty much in balance.
You are, I think, the bank most into the cannabis space, certainly a big player. Last time I interviewed a cannabis CEO, he bragged that he'd just been to lunch with you. Not that long ago, none of you would touch this stuff. But do you worry about valuations in that space? It's been, obviously on the equity side, a bit of a heady ride. Where do you fit that into your thinking about it?
Well, anytime you have a new market, if you look back to lots of new markets that we've seen over time, you go back to the late 1990s and we look at the technology evolution as we went to e-commerce. If you look at some of the junior mining plays that we looked at through the course of the following decade and the decade after that, we've got a really disrupted market right now, and we've got new entrants coming into it every day, and we have a value chain that hasn't been completely sorted out yet. Most of the time you spend looking at it from the outside in, you see producers, but you haven't yet seen full value chain effect, and you haven't seen brand. And I think the answer, if you're asking whether we should expect to see volatility as you go through the evolution of a new business model, the answer is absolutely. We're going to see disruption for some time. And when I say some time, I expect that to be years, not months.
Just finally, when we look at kind of the digitization and your expectation of how much of your sales will be digital transactions, do the banks have to think about how you justify fees when you change the service model? I can't walk into the branch necessarily as easily and talk to a human being. And maybe I don't want to. Yeah. Does it change your fee model as well?
Yeah, and that's a very good question, because you yourself said maybe you don't want to, and you may not want to, but somebody else may want to. So what happens is, you have to, as a service provider, because we are in the service industry, yes, we're a technology-driven enabler of services, you have to be able to meet the customer wherever they are. And what you find is, for example, we've got 25% of our sales are digital. Everyday transactions, we continue to see an increase on digital transactions all the time. But when there's a moment of truth, you'll see customers do research online, and then they'll want to walk into the branch. And so the branch will be active. It'll be at the heart of everything we do, I think, for a very long time. The contact centers will be very important. So the multi-channel omnibus service is going to continue to be important, and it goes to the cost to serve model, and it goes to the fee model as well.